I'm Daniela Camboni, and you're watching Tuesday's edition of Reset. Markets were sliding deeper into negative territory today as traders are worried about the gloomy outlook for the world economy. This is following the news today that the IMF stated it sees an alarmingly high risk of a deeper global recession. This follows yesterday's news of the World Bank cutting the growth forecast for China. And finally, how about those job numbers from last week? We'll be getting Vince-Lanci's point of view on all of this coming up on Reset. Vince, so good to see you again.
You too, Daniela. Nice to see you.
So Vince, lots to talk about today. Let's start off by recapping the situation in gold. As we're speaking, COMEX gold hits a daily low as the US dollar index pushes to its daily high. My question to you, Vince, does this have anything to do with the protests in Greece over Merkel's visit, which is pressuring the euro but seems to be supporting the greenback?
Well, I mean, indirectly it is. But I wouldn't say it's about protest per se or a reaction to it. It's essentially the market's losing faith in the euro again and putting money in the dollar. And gold is just tracking the dollar right now. There's nothing extreme that would boost gold currency-wise. The Middle East issues, possibly Turkey, should be boosting the gold, but they're not. Oil's up over $3. So that's pretty negative for gold to not be up with Middle East tensions.
So Vince, let me ask you, recently the CFTC reported net speculative long positions. Should this not have added to price momentum?
There are times when the answer to that is yes, but there are times when the answer to that is it's a counterintuitive or it's a contrary indicator. There's only so much money allocated into precious metals, and when you see a market get to its historical highs of longs, people tend to say, oh, there's too many people that are long in this market, and the market starts to sell off as people take profits.
Vince, there are some analysts who have gone on the record saying that we should expect a bloodbath to take place in silver soon. What are your thoughts on that?
Well, I'd want to ask them, what's that based on? My thoughts are, just looking at the charts and our probability models, silver is weaker than gold right now. It looks like it could drop a lot more. But by the same token, there's just not as much interest in silver. And I would need to know what a bloodbath means. I will say this, though. Gold is now moving more like currency and money. And silver is moving like currency sometimes and industrial commodity other times. I would have to suspect that the people who believe silver is due for a bloodbath are either chartists or people who think that silver is overvalued as an industrial commodity. Easier said than done.
All right, Vince, let's take a look at your weekly chart now.
Yeah, we sent a weekly chart. We have been working with those with you for a while, back when silver was trading in the 1540 range. We had identified a big range and noted that we were near the bottom of it. And I think there's an oval circling the tails on some of the candles. If you look at the market since then, we're at the top of, almost the top of a 2-year range. And there's no reason to think that you should not be taking profits at these levels. So to the people who are nervous, oh, gold should be going to 2,100, we gave you this just to say, hey, from May to today, we went up $230. Relax. We can drop $30, $40, $50, and that's very healthy for the market.
So, Vince, what's the new resistance level for gold that you're looking at?
We had a goal. I think we stated our first goal of 1805 and then 1835. We never quite got there. We got to 1797 and change, which is disappointing if you're a dart thrower. But it was quite heartening if you're a person who's just looking at the markets and looking for momentum. Our levels are now... we believe gold can retrace to 1735. This is probabilistically 1735 and be healthy. Then it could breach 1805 and run to 1835, 1850, and then who knows where from there. But we think that odds are market goes down first before it goes up.
So Vince, why was gold not responding to the news from the IMF today? They reported that the world economy will grow 3.3% this year. That's the slowest since the 2009 recession. Should gold not have been performing better?
Well, let's take it as gospel. Let's just assume for the moment that they're absolutely 100% metaphysically right. Okay, if that were to happen, what would the reaction be by the U.S. first? There'd be no reaction. There's nothing to do, monetarily speaking. He's done it. Ben Bernanke's done it. We are in QE3, QE infinity, QE eternity, whatever you want to call it. So that would, assuming the U.S. were the only economy in the world for the moment, the only Fed in the world, then if the IMF says we're going to be in a great recession and the Fed has no more bullets, then no asset price goes up. Recession equals deflation. It just speaking about the U.S. for a second, it just emphasizes that, say what you want about Bernanke, he pulled the trigger on something that he truly believes needs to be done. My guess is he had looks at information beforehand that do not look good in the future. As to your comment about Europe, Europe has room to move, but they don't have the will to do it. So maybe the IMF is trying to sell them on doing something. China, there's no good news coming out of China. And there's no reason to think the IMF is on the wrong path in stating what they are stating.
Okay, next news topic, Vince. World Bank yesterday slashing China's growth forecast. Might this hurt gold since China's one of the primary buyers of gold?
Well, that's a great question. First of all, this is opinion, conjecture. We don't think China can do much more to help itself to prop up its GDP. And we think that's because any more easy money in China is going to cause domestic inflation. And that's in fact what's happening. Civil unrest would be the undoing of a Chinese economy. With regards to gold, that's an unanswerable question, but I can give you both sides of the coin, and I think both you have to keep your eye out on. Does a slowdown in China mean a slowdown in purchases of raw materials? Yes, you can see that in the Aussie dollar. You can see that in purchases of iron ore, in purchases of copper. You can see that in industrial commodities. Would you see that in gold? You might. I don't think you would, because gold isn't used to make anything. Gold's money for them. It's a diversification away from the dollar. And the faster they diversify out of dollars, the faster they can help their domestic inflationary problems. So it may put a perception, there may be a perception of gold demand dropping from the Chinese, but I don't think that's going to happen.
All right, Vince, I can't wait to speak about this next subject with you. The jobs numbers that came out Friday, unemployment rate dropping below 8% for the first time in 4 years. A lot of people were asking, if we only added 114,000 new jobs in September, how did we go down that fast? And some, including the former CEO of GE, Jack Welch, suggesting that perhaps these numbers were manipulated. What's your take?
Yeah. Tony's on the other side of the desk, and he made a cuff comment that's actually accurate. It's a denominator move, not a nominator move. People aren't looking for jobs anymore. I mean, you can make any case you want. Just first to speak about the jobs number itself, before we get into the tinfoil hat manipulation stuff, which I subscribe to. I just don't have my hat on today. The jobs number was very good. Factually speaking, it was the best since Obama took office. It comes on the heels of debates and elections. It certainly looks like cooked books. The markets reacted. The gold market reacted negatively because the gold market sees that any improvement in the economy that's meaningful will allow Bernanke or his successor to remove easy money. Pull away the punch bowl is the old cliche. The stock market rallied strongly at first because, hey, that's good for the economy, it's good for stocks. But then those gains were given back because the stock market is built on fluff right now too. As to manipulation, there is no such thing as manipulation. There, however, is cherry picking of data, which the Fed likes to do. There is timing of releases, like send out that a bank failed on Friday afternoon when no one's paying attention, which the Fed likes to do. There's a changing of CPI to remove oil and food, which the government likes to do. So I wouldn't call it manipulation, although I wouldn't, go toe to toe with Jack Welch. But the reality is this: the numbers can be changed either through footnotes. You just have to drill down and do the math. If you want to just go with it, maybe last quarter's numbers, last month's numbers were manipulated to make these look better. These numbers could just be totally honest. But what we're looking at here from a trader's point of view is markets are managed, not manipulated. If the CFTC catches you doing it, you're manipulating. But if someone in control is doing it, they're managing expectations. CEOs manage expectations of shareholders by holding back on what their earnings are. Apple does it. Everyone does it. So there's no reason to think that the government doesn't do it. But this is just ridiculous if this is a manipulation. So I'd have to say, no, it's too obvious. And even if it is a manipulation, I already know not to fight the Fed. I haven't shorted bonds yet, although I've wanted to for 2 years. So you just have to live here or move.
Okay, so Vince, yes or no, in your opinion, was there some funny business?
No, but I have no reason to believe they were not. If they were, then all numbers are manipulated. I don't think the government has to manipulate numbers to do what they want to do. They can just change the rules.
Okay, Vince, let's bring it home. Looking back at gold, it may not be making new highs in US dollar terms, but it recently made highs in euro terms, correct?
We sent you a chart showing that relationship. We've been talking ad nauseum, as has everyone else, that we're looking at the world starting on competitive devaluations to lessen their debt. In English or in human terms, that means we're going to print more dollars to make our debt worth less, to get us out of debt. And the Fed has been ahead of the curve in doing that, and Europe's been behind the curve. What that should mean is that as the dollar weakens, the euro should strengthen relative to the dollar. That also means that gold should go up relative to the dollar and should go down relative to the euro. Now, if you look at gold on any given day, any given hour, minute, second, you'll see those relationships. If gold goes down, then most likely the euro is going up as a correlation with the dollar. But look at the chart that you have there. And if you look inside the box, the yellow line is the price of gold. The blue line is the price of the euro. Now, in 2011, I remember this happening and hoped it would happen forever, but I was wrong. Gold started to diverge from the euro, in fact, move opposite it. And you can see gold going up while the euro going down. And this was during about a 6-month period where Europe started really frothing in terms of crisis. And we think Paulson was buying that time too. So here you have gold actually going up with the dollar, right? The euro is going down. Then margins were raised at the end of the year, and gold went back to the way it should be historically in relationship to the euro. But now look after the red line, after July, a total divergence. Gold is competing with the dollar for European money now. That's going to happen in every currency worldwide as time moves forward.
Vince, thanks so much for your thoughts today. We'll see you next week.
My pleasure. See you next week.
And thanks for watching this edition of Reset. You can email me as always at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.